Good evening, everybody. Thank you so much, Lisa, for the nice, warm introduction. And without further ado, we'll talk about Social Security. As Lisa mentioned, I am a principal of ClearBridge, also worked many years with Financial Planning Association. And today, this presentation was based on material provided by Vanguard, and we applied certain information on the top of it to give you some most important updates. There is a lot to discuss about Social Security. Social Security is a very important topic for one reason, that a lot of people rely on Social Security for retirement after the age of 65. And in general, Social Security income replaces about 1/3 of retirees' expenses, which means that about 1/3 of your overall expenses in retirement will be funded by Social Security. So knowing your benefits, how to take them, when to take them, how they work, how they've been created is important for general, but also for your retirement planning. So let's begin, and I'll be happy to answer any of your questions if you can put them in the chat. Lisa will go through them in about 15-20 minutes midway through the presentation to make sure we'll address them as they come. Today we talk about 5 major topics. First is Social Security basics, what it is, how it's been created, just quick history. We'll talk about spousal benefits. People ask about it all the time. We'll talk about survivor benefits. If spouse passes away, what kind of benefits you can count on. Divorce and Social Security, how divorce benefits work and how you can take advantage of those if you're in that situation and what you should avoid. There's a few mistakes to point out. And the last one is special considerations, different circumstances. Most important part of this presentation, we'll talk about how we optimize the benefits. How do we take them appropriately so we do not regret our decisions in the future? So history of Social Security, it was created in 1935 during the crisis, and first person who received it, it was in 1937. And you can see through the history, there's few milestones to acknowledge. For instance, first cost of living adjustment happened all the way in 1950, not right away. And then women were granted rights to retire earlier than men. That will happen in 1956. Right now, that doesn't matter. You can retire at the same age, and there is no difference between women and men. And in 1983, Reagan taxed Social Security benefits and raised full retirement age. That was a huge deal. And since then, Social Security benefits are taxed based on your overall income, which we'll go over in a few minutes. So how does Social Security works? So Social Security is funded by 2 sources. One is from your Social Security payments that you will see on your pay stub, and it's usually broke down in 2 parts. One part you see, which comes on your paycheck, it's 6.2% of your wage, and up to $160,000 of wage is taxed for Social Security. Anything above it is not taxed. And your employer also pays into the system about another 6.2%. So that's one part. It's called OASDI. Now, Medicare also contributed toward the same system, and it's to pay for your Medicare benefits. And employer pays 1.45%, and you also, as an employee, pay the same amount. There is no income limit. If you make $300,000, you will pay 1.45% on that Medicare on that income. Higher earners who make over $250K married, filing jointly can potentially also pay additional benefits on investment income into Medicare. We call it a supplemental tax, so we call Obamacare tax. So all of these income sources go into one place, and then Social Security benefits will be distributed to those that are collecting currently from the pile that's actually coming from the current workers. So that system works pretty smoothly. A lot of people concerned about not receiving Social Security benefits. From my reading and from what we've seen lately is, even though Social Security was slightly underfunded in the last few years, it's actually getting back on track because the administration is pushing Social Security full retirement age further and further and further. So people who were born after a certain age, I will show you the table in a minute, can start receiving full benefits later than the older folks. So we'll go through that. graph in a minute. How do you qualify to receive benefits? So you need to have 40 working credits. One credit currently equals $1,640. So if you or your child or your parent made at least $6,560 in earned income, in wage, then they will get 4 credits. A lot of times what I see is spouse worked but only earns 38 credits. 2 more credits left or 4 more credits left, and they stopped working. They have to take care of a family member. I tell them, please work for a little bit more, at least to make 6,500 to get those additional credits, because if you don't have 40 credits, you don't qualify for any benefits, which means all of those 38 credits are gone. So it's very important for you to pull out the statement, to take a look how many credits you have, what the benefits look like. Recently, I had a client who came in and told me, I was young, I didn't pay attention, I pull up my benefits. I see that my employer, when I was in my 20s, didn't report some of the wage that I earned, and I paid Social Security tax on it, but I'm not getting any benefits. Well, luckily, because they usually take 35 highest earnings years, she has enough. But for those years she worked and Social Security didn't receive any records from the employer, which can happen, she will have 0 instead of what she was supposed to have. So we need to be very careful in reviewing the benefits, not 1 year before retirement, today. Doesn't matter what your age, if you're in your 30s, 40s, 50s, please take a look on the benefits, go log in into socialsecurity.gov, create your account, take a look on your benefits, take a look on your reporting earnings, make sure all of this data is accurate. I suggest doing it at least every couple of years, then you know things are doing well and you know how much you're getting. All right, so maximum benefits in 2023 for age of 62, if you want to collect sooner, is 2,500. At the age of 70 is 4,500 max. See the huge difference. If you're collecting your benefits later, you will see that your benefits grow pretty nicely. Full retirement age, maximum benefits anybody can receive at the moment for 2023, 24 is a little bit higher, is 3,627. So these numbers are set in stone because we know that the amount of wage that is taxed for Social Security is 160,000. So if you make more, it doesn't mean you pay more into Social Security. That's why these benefits are capped. Very important to know when you're doing your planning. We need to recognize what is happening with your benefits and how much you can count on. Full retirement age, what that is. So full retirement age is where you collect your benefits that already been vested completely. And it's different age for different people. People who were born in 1955, it's 66 and 2 months. People who were born before that is 66 years old. And people who were born at 1960s and later, it's 67. So anybody who born between 1955 and 1959, they will be 66 in certain months. So please make a note that every month, let's say your full retirement age is 66 and 10 months. If you decide to take your benefits at 67 instead, your benefits will grow. They will grow for the number of months, and it's recalculated on a monthly basis. Number of months you postponed, and it will grow accordingly. So those are very important, because if you collect your Social Security prior to full retirement age, which in many cases does not make sense, then your benefits will be reduced. So you do need to know when is your full retirement age and how much you might be collecting. Let's review real quick COLA, its cost of living adjustment. It's important to keep in mind that inflation affects COLA. For instance, if we look at 2023, you can see that the benefits are being inflated very heavily. We had 8.7% inflation adjustment on it. We have not seen that number since 2004. So inflation has been a big drag on your consumption, but also it's been a benefit for Social Security payments, because people who collect in Social Security can see that the benefits increased almost by 9%, which is great. That's a great news for us. What age can you take the benefits? So the formula is fairly simple. If you want to take benefits at 62, you can do that, and your full retirement age benefits will be reduced by 30%. And every month after 62, the reduction is less and less and less till it disappears. So if you decide to retire sooner and you don't have other sources of income, and your longevity is not too long based on your family, then potentially you can collect at 62. The disadvantages of collecting it, and those are the questions you can ask yourself. Are you still working? Do you need income? Are you in good health? How does your benefit compare to your spouse? Once you start collecting benefits, you can probably stop them and repay the benefits back to restart them at the full retirement age, but it's a huge hassle. So if you're working, if your longevity is at least 83 plus, and you have some savings, collecting at 62 most of the time does not make sense. So keep it in mind, making this determination very carefully. Few of my clients, when they come to me and they say, I want to collect at 62, I'm really tired of waiting, I really want to spend more money, I want to travel. And when we review the overall picture, big picture, the tax implication, the benefits laws, everything else, financial plan, cash flow, many times we determine that 62 is not a good age. But you need to go through that redetermination just to make sure that your decision is the best. It's optimal decision for your Social Security, because once you start collecting, a couple years down the road, you won't be able to make the changes that will be permanent. All right. How benefits change with age? If we just talked about at 62, you imagine that somebody collecting 2,113. If that person decides not to collect and collect at 67, that number becomes $3,000. So you can see if your full retirement age is 67, then at 62, you're only collecting 70% of your benefits. So you're reducing them by 30%. If you are collecting them beyond your full retirement age, 67 in this case, which is the 100%, and you decide to wait all the way till 70 because you have other sources of income, maybe you continue working, maybe you're doing part-time consulting, then at the age of 70, you will collect 124%. So Social Security benefits grow at least 8% a year while you are not collecting them. And it's a guaranteed growth, which is very, very attractive. Average lifespan if you reach age of 65. Great statistics here. So if you look at average lifespan for men who reach age 65, they can live till 86, and women almost 90 years old. What does it tell us? It tells us that if you're living beyond 83, collecting your benefits before 67 does not make sense. There is something called equalizing calculations I do for a client. I show them an Excel sheet, the difference in dollar amount if they collect at 67 versus a different age. And I show them cumulative difference, how much total they would collect in one case versus the other. And sometimes differences 50,000, 100,000, 300,000. So you can see the difference if you decide to collect a different age. Let's take a look if it makes sense and how much money you're leaving on the table by collecting sooner than later. Take a look at the statistics. So if you reach age of, what's the chances of people reach age 95 once you are past the 65 mark? Well, you have a 40% chance to live to the age of 95 if you're already 65. It's a significantly increased in the last few years because of the advancement in medicine, people living longer, healthier lifestyle. And if you are at 65, the chances of you living till age of 90 is 66%. For women, it's a little bit higher, for men, a little bit less. All right. So let's take a look. Break-even age. So break-even age, if you live until 90, so if you full retirement age, let's look at Deb. Deb waits till full retirement age of 67, 3,000 to start. So her break-even age means she will need to live till 79 in order to break even of collecting a higher benefits and waiting. So as long as she lives beyond 80, and we just looked, there is a huge chance if she is already 65, she will live to age of 80. It's a very high chance for women, 65%. So it is very likely that she will potentially might opt out to collecting at a later age if she has other resources. If she doesn't, then of course decision can be made to collect at full retirement age. Let's look at Pat. So Pat waits till age 70. She's collecting to start 3,720. And Pat's break-even age with Mike is around 79. So you can see here from this illustration that A, your benefits amount, B, what is your break-even point, and C, amount of benefits that you can collect that might surpass your overall collection of benefits should you start it either early or at full retirement age. So big conclusion that if everybody live until age of 90, then Deb ends up with $122,000 more than Mike. Why? Because Mike started collecting at 62. So Pat ends with additional 66,000, not taking into account cost of living adjustments. So collecting at an early age could be more exception to the rules than the rule itself. So it's usually very few people I would advise to collect earlier, with certain exceptions, which we can review if there is any interest of that. Earning test. So this applies only to people who are collecting benefits and then have not reached full retirement age. Because if you are starting to receive Social Security benefits before you fully retired, so if you work beyond 66 or 67, your benefits are not reduced, they're just taxed. But if you be collecting Social Security before that, and your earnings are over a certain threshold, Social Security will take $1 for every $2 above the thresholds. And take a look on this threshold. It's very, very low. It's $21,240. Year after you reach full retirement age, the threshold is 56. So the goal here is, as long as you're working, not to collect benefits, because otherwise your benefits will be A, fully taxed, and B, they will be reduced. So you pay attention to not be able to collect at the certain age and continue increasing your benefits by far more advantageous than starting collecting and continue working. So let's talk about the case study. Joan files at the age of 62, right? So she files early, and she's still estimating to make commission. Maybe she's a realtor, and $45,000. Her monthly benefits is $2,000. So how much over the earning test she's making? Well, $45,000 she's making minus 21, which is the threshold. She's making $23,000 more. How much she will get withheld? 23 divided by 2, because it's reduced 1 to 2. So her benefits will be reduced by 11,820, and 11,820 divided by 2,000 benefits, 6 months of monthly checks will be withheld. Huge amount. Huge amount. So if you're working, even if you're not making a lot of money, you collecting Social Security benefits makes no sense, because a lot of it is going away. You would rather wait, let those benefits accumulate with inflation, and then collect it later. Spousal benefits. A lot of people are asking, there have been a lot of changes in the last few years about spousal benefits. One was very popular. I talked about it all the time during the presentations, called file and suspend. This one is no longer available, which means spouse could have filed benefits, but that's suspended not to get payments. But as a result, they could wait on their own benefits collection and collect spousal benefits. They can file on their own, not to collect it and collect spousal benefits. Their own benefits, let them run higher. This is not available. These days, if you want to collect spousal benefits, you make one decision to collect it and you stick to it. You cannot switch to your own benefits anymore. So collecting spousal benefits is very tricky because A, based on your age, life expectancy, B, based on how much your full benefits look like compared to spousal. If your own benefits is higher than spousal benefits, you should not collect, obviously, spousal, you should collect your own. And ideally, you can collect your own on the full retirement age. But in order to collect any spousal benefits, you need to be married at least for 1 year, must be at least 62-year-old, and your spouse, your husband, must file for their own retirement benefits. I'll give you one example. I have a wonderful couple at the second marriage. He turns full retirement age. They got married a couple of years before. And once he starts collecting his benefits, his wife is 62. They've been married for 1 year. She didn't work in this country. She's from a different country. But because she is U.S. Resident, they've been married for 1 year. She's 62 and he's collecting. She's eligible to receive 50% of his benefits, which was a huge surprise to them because they didn't know she would be even eligible, but she is. As long as she's a resident, she has green card, she has a social security number, she's eligible to collect. Usually those spouses who stayed home, raised family, their benefits are not as high as half of the husbands. Then in this case, they can take half of the spouse's full retirement age benefits, right? We call it PIA benefits, primary insurance amount. So primary insurance amount is your full retirement benefits your spouse can collect. If your spouse collects before their own full retirement age, let's say if spouse collects at her age of 67, she gets 50% of her spouse, of his benefits. But if she collects before her full retirement age, the benefits are reduced dramatically. So collecting spousal benefits before that age of full retirement does not make sense because the benefits get reduced dramatically. So it's better to wait to your full retirement age and then start collecting as long as your spouse is already filed. And 50% benefits, especially for the high earner spouse, would be a good amount, significant amount of money, and you can collect. I would like to go to this chart and just talk about a couple of case studies. So switching strategies. Ellen is 65, high earner who plans to retire in a year. Her wife, June, is age 67, already retired with her own workers' benefits. That is much less than half of the Ellen's full retirement age. So what's the answer? Then June will collect 50% of Ellen's benefits because Ellen benefits are higher. So in order for you to make the determination your eligibility, you need to go to Social Security Administration together and collect all the data depending on when Ellen is retiring, when the June can retire. Now, it does not make sense and the benefits do not grow after full retirement age. So let's say June decided, I'm not going to collect at 67, I will collect at 70. It does not make sense because those benefits will not increase. Usually your own benefits go up 8%. Spousal benefits are locked at the full retirement age. So collecting beyond 67 on spousal benefits does not make sense. A lot of people don't know about it. Survivor benefits. For those who outlive their spouses, they have a chance to switch to their late spouse benefits if those benefits are higher. If they're higher, widow can collect spousal benefits and switch. Widow cannot collect both, his own or her own and spousal. It's one or the other. But spousal benefits are 100%. They're not 50 like for spousal benefits. Survivor benefits are 100% of your deceased spouse benefits. Obviously, your spouse must have 40 credits. We know that, eligibility rules. Widow must be at least 60 years old and cannot remarry before age of 60. Extremely important. Example, life example. Client lived with her husband for 30 years. He was a high earner. He passed away. She was 58. And she remarried a year later or a year and a half later, right before she turned 60. By doing so, she became ineligible to collect good survivor benefits on her late husband. The new husband benefits eligibility start to kick in, but he was a consultant and he was not making as much money. So she gave up very good benefits. So if you want to remarry, you need to wait till 60. After age of 60, it doesn't matter. You can collect your own, your late husband, or your new husband. And I'm saying husbands because usually women outlive men, but just an example, it could be always the other way around. That marriage, by the way, need to last at least 9 months in order for you to collect. And if widow is not at full retirement age, there will be a reduction in benefits. So to summarize, simply is if you're collecting on someone else's benefits, either spousal or survivor, you need to collect it at your full retirement age. Otherwise, your benefits are reduced. Also, don't forget earnings test, because if you're still working and making some money, then some of your benefits can be reduced because of the earning test, right? So that we need to keep in mind. For survivor benefits, one thing to remember, there is no delayed credits past your full retirement age. So we need to remember it. After 67, you're not getting delayed credits. You're not getting more money. So waiting beyond 67 for survivors do not make sense. Start collecting at the full retirement age. Let's look at a few scenarios. So deceased did not start benefits and was under full retirement age. So 100% of primary insurance amount, deceased was at full retirement age or older, did not start the benefits, also 100%. But if the person who passed away took early benefits, then the payouts will be reduced. So that's one of the considerations for planning is if one of two spouses, one is a higher earner, you need to optimize and maximize how and when that person takes the benefits. Because if he, let's say it's he, takes the benefits before full retirement age, he is at a reduced percentage. And that reduced percentage will be passed to the spouse if he goes away. So you need to optimize it for him, for the family, and also for her if she's left after him as a survivor. So you need to be very careful about it. A lot of times people don't pay attention to those little details, but they matter a lot. Increasing and maximizing benefits for that spouse who earned the highest is extremely important because survivor can take that amount. And chances that survivor will take that amount is very high because chances of two people living longer is higher than just one person, right? So not to beat the dead horse, we know that taking it before full retirement age is not always advantageous. Do you claim your own workers' benefits or survivor benefits, right? So number one, claim the workers' benefits at age of 62 is switched to the survivor benefits at full retirement age. So for widows who have their own workers' benefits, right, which is less than their deceased spouse, no delayed credits on survivor benefits. So take it at full retirement age. So you're on your own benefits, your spouse passed, so you can start taking it at your full retirement age, your spouses, right? Number two, claim the benefits with the greatest monthly value when you initially file. So you need the income and you want to claim the highest amount right away, and the survivor benefits is the highest, if the survivor benefits are the highest. So again, we're talking about optimizing survivor benefits. And it depends on your full retirement age. So at your full retirement age, you're eligible for the full amount, right? Claim survivor benefits at the age of 60 and switch to the workers' benefits at the age of 70. So that's another strategy. So if you became widowed very early and you're at age of 60, you can start collecting survivor benefits at a reduced amount, but then you can let your own grow. If your own workers' benefits with delayed credits would be higher in the future years than survivor, you can get income while you wait for the highest benefit. So that's the thing that's still available. You can get on the survivor benefits wait till your own benefits grow. If your own benefits surpass survivor benefits, you switch to those at age of 70. If they don't become higher, then you can stay on survivor benefits or maybe choose to be on your own. So you need to evaluate three options: your own benefits at full retirement age going forward, survivor benefits 67 till 70, and how your own benefits will grow should you leave them alone and only live on survivor benefits. So there is a lot of little things that you need to consider. Once you're a survivor, you need to sit down and figure out all the numbers to make sure that you're optimizing those payouts. If your spouse, you divorced your spouse and your spouse passed away, then you're still eligible for those benefits if you have not remarried. And you can get survivor benefits on your ex-spouse. Number one, you must not remarry. If your ex must be 62 or older, ex does not need to file. As long as your ex is 62 or older, you're eligible to collect. You must be married for 10 years. You must not qualify for the highest monthly benefits on your own records, which means your own records is not as high, and you must have been divorced for at least 2 years. If less than 2 years, ex must be receiving benefits. So which means that if your ex is receiving benefits, there is no waiting period. If your ex is not receiving benefits and he is not planning to apply, then you need to wait 2 years. You ask yourself, how do I know if he applied or didn't apply? The simple rule is, you take your ID, you take your marriage certificate or copy or date, and you take social security number for your ex. You go to Social Security Administration and you find out if benefits has been collecting, right, from on his benefits. They will tell you you're eligible for the divorce benefits as ex-spouse. Remember, divorce benefits will stop if you remarry. If you remarry, all divorce benefits are gone. Extremely important. I had a situation where people divorced in the still early 50s. So they've been married for many years. She was eligible for his benefits and they were pretty high. When she remarried again, those benefits are gone. And then her second marriage didn't work out. And they divorced sooner than she became eligible for his benefits. And now she cannot collect ex-spouse, she cannot collect the second ex-spouse, so she only stuck with her own benefits. So you have to be extremely careful. I know it's not a fun subject when you're talking about marriage and fun stuff, but it's something to consider because it can make a huge effect on you for your retirement, for your safety, for your security. So that part needs to be talked through with your financial advisor, with your planner, or with Social Security Administration. Social Security considerations. Windfall elimination provision. I just want to mention that certain organizations like railroad retirement benefits, certain government agencies, they do not participate in Social Security system, which means on your paycheck, you will not see that money being withheld because the money that been withheld go into a different system. And that system will make you eligible for benefits similar to Social Security. So if you never contributed into Social Security, guess what? You will never be collecting. Some people worked for those organizations for a number of years, and they also worked long enough for Social Security, at least 40 quarters, to qualify for Social Security and been making contributions toward benefits. Then they're eligible for both Social Security and the other system. Now, the way government works with that, they say, well, if you're making over a certain dollar amount, it's called substantial earnings amount, then your benefits will be reduced. And the amount of reduction is based on a formula, substantial earnings, a Social Security covered job. So you can see that basically they will reduce your Social Security benefits based how much you're collecting outside of the system. So this is called windfall. It's some sort of, checks and balances system where they say, hey, we understand people who worked for Social Security, collected highest 35 years, this is the benefits. But if you work for other system and on top of it, you'll be collecting double it. So they want to make sure that you're not collecting overly what Social Security otherwise would provide. So between what you're collecting from other pension benefits and from Social Security, those numbers together cannot be higher than the highest payout for Social Security for the highest earner. So that's the idea of that. If you're part of the system like that, talk to a financial person to figure it out. It's a little bit more complicated than just on the paper, just to figure out what will be the reduction. It's not very straightforward. There is a formula involved. Government pension offsets, that's exactly what we talked about. So as we know, your taxable Social Security amount currently is 160,000. So if you're making more than that and your pension benefits are paid, there'll be an offset. And an offset means that your benefits can be reduced. Same idea. I think the best thing to do is to go at the age of 62 to a Social Security Administration, maybe even sooner, and figure out, are you subject to offset? Why it's important? Because then you would need to know how to plan for your retirement. You might be counting on $3,500 a month, but it could be a different number because of the offset of the government pensions that you might be receiving. Let's just give an example. Donald pension is $4,000. He worked for a construction government organization. Martha retires at full retirement age with her benefits of $2,900. Martha dies, so the Donald survivor benefits would be 2/3 of 4,000 benefits, or 4,000 pension, or 2,666. So there is a reduction. Martha PIA full retirement age 2,900 minus the offset. So Donald monthly survivor benefit payments is $234. So he is getting very different number. Otherwise, you would see if Donald would not have the pension. If Donald wouldn't have a pension, all of these calculations and reduction would not apply. See, it's actually a pretty big reduction, right? You can see that knowing that he's making so much in pension benefits, his monthly survivor benefits payments are pretty low. That needs to be part of the retirement plan, because if one spouse dies and they're accustomed to living on $6,000 a month and now he has to live on $4,200, then it's quite a bit of adjustment to the person's lifestyle, and that needs to be planned. It cannot be at the moment of truth saying, well, you need to reduce your lifestyle, or we cannot afford to live in this area, we have to downsize, we have to sell. So these things need to be planned. Will your Social Security benefits be taxed? Most likely, yes. Why? The reason is because if you look to the right, it says the joint filing status, unless you make $31,900 as your total income AGI, or less as a family of two, which almost unheard of in Bay Area, then zero of your Social Security will be taxed. If your income for the joint filer between 32 and 44,000, which is always not the case in Bay Area, then 50% of your Social Security benefits are taxed. Anybody as a family here or outside of Bay Area makes over $44,000, up to 85% of their Social Security benefits will be taxed, which is unfortunate because you already paid into the system, you don't feel like you need to be taxed, but as you've seen it, the Reagan made a change in the 80s saying that your social benefits will be taxed, and the more you make, the more it's going to be taxed. But the highest amount of taxation on those benefits, it will be 85%, not 100%. So 85 is the highest amount. Usually it ranges between 50 and 85 depending on your income level. How is it calculated, this income? So it's adjusted gross income plus tax-exempt interest. So if you decide to put all of your investments in bonds and they're earning $50,000 of tax-free income, that income is brought back into calculations. Then you will exclude foreign income. You would add foreign income, and you also will add 50% of Social Security benefits. This is called provisional income. If this provisional income is over $44,000, so joint filer was $34,000 for single filer, up to 85% of your benefits will be taxed. What are your financial goals? So the biggest consideration out of any information that you receive is you need to know a few things. First, what kind of resources do you have to live on if you decide to maximize your benefits and you would like to collect it either at the full retirement age or beyond? What's the benefits of waiting, and what other resources you can use meanwhile? So that's open up opportunity for planning. Are you worried about large RMDs amount at age of 73? A required minimum distribution now is pushed out to age of 73 and you have to take the money out. Does it make sense while you're waiting for the Social Security benefits to kick in, maybe to do IRA to Roth conversion and reduce your RMD distributions, right? So there is a lot of planning considerations. A lot of my clients who are able to retire at 62 were not collecting benefits. We are doing Roth conversions till they start receiving pension benefits, Social Security benefits, and eventually RMDs. So planning your retirement benefits, Social Security, and on the top of it, calculating your income to stay within the threshold for Medicare premiums, all of it comes in one big cash flow analysis. And as you go through it, you will see that there is a ways to optimize it. There is a ways to collect benefits in appropriate time. There is a ways to stay under your Medicare threshold if possible. There's also ways to collect your benefits when you need them the most at the right appropriate time, and also optimize how much you collect between you and your spouse. You don't want to make a mistake, no, because it's very costly. I've seen many times people turn on benefits because then they have a conversation with me a few months later, usually not my clients, somebody came on board, said, I just started collecting benefits, what do you think? And the person is 63. I said, no, it does not make sense because of this, and that. So then we have to refile, ask them for return the premiums back to them, benefits back to them. So you need to kind of measure it 10 times, cut it once. So once you know what you're doing, how you're doing it, then you have a plan. So if you received more than 12 months of checks, so you can suspend it and no paybacks of benefits, 8% growth on your early benefits. So if you have less than 1 year of benefits, you can repay them. So basically after 1 year, it becomes permanent. Before less than 1 year, you can still repay them and get do-over. It means redo it, wait for benefits and reassess them and collect them later. Any questions? Call Social Security Administration. Do not ever provide your personal information, address, name, birthday, Social Security number to anybody who calls you and tells them they're calling you from Social Security office, because the office will not call you. They will never call you. They might call you as a return call, but very rarely. Usually they will never call you, and they will never ask for your private information. A lot of scammers calling retirees that know they're not as financially or aware of these scams. So do not ever provide any of your information unless you're making a phone call yourself to a legitimate Social Security phone number. All right. So action items. You review your earnings record. We talked about that in the beginning of the presentation. Determine your goals around Social Security, when to collect, how to collect, spousal benefits, your own benefits, survivor benefits, how things can work out. Work with your financial person to optimize it. Extremely important. That's 1/3 of your overall expenses you'll be using to pay. And develop a solid retirement income strategy where Social Security is an integrated part of it, for both you and your husband or for yourself alone. All right, so this is all we have for today. I would be happy to answer any questions. I hope that we have a few of those in the chat. And I think
hi, Larissa. Yeah, there are some questions.
Sure.
One of them, let's see, Delia asked, she wants to confirm whether her understanding is correct regarding retirement at age 62. She understands that if she retires at age 62, her benefits are reduced by 30%, correct? And she wants to know if this reduction is the case for the rest of her benefits for life.
Great question. So if you are a widow, you can collect Social Security benefits as early as 60. If you are collecting on your own benefits, nothing available to you, zero, till your age 62. Once you reach age of 62, you can collect by 30% less. Otherwise, you would receive at the age of 67. I'm assuming if you were born after 1960, right? So at your full retirement age, let's give an example, your benefits are $3,000. If you decide to collect those benefits at the age of 62, those benefits will be reduced by 30%. So $3,000 will become $2,100. And you will collect those benefits with inflation adjustments for the rest of your life. If you say, no, I don't want to take it 62, I want to take it at 63, then the benefits will be reduced not by 30%, by a little less, most likely about 25%. And then as you wait, it gets from 70% of your full retirement age collection benefits to all the way to 100. And it's a gradation month by month by month. But yes, once you start collecting it at that level, you will get no bumps in benefits besides inflation. Inflation still will increase your benefits, but very slightly. 3%, 4%, like this year, benefit increase is only 3.4, I believe. Last year was 8%, which is unheard of, but you will only get inflation adjustments. Your benefits will not grow otherwise.
Okay, thank you. And then let's see, Alan asks whether the Social Security earnings, whether income, I think this is when you were talking about what is taxed. Your Social Security earnings are taxed, or a portion of them are taxed, right? 80% of whatever your earnings are would be taxed.
Right. So if I understood that correctly, income doesn't include the Social Security. Oh, it does include. It does include. Let me show you that slide right here. So if you want to know how much, if I understood the question correctly, if not, please type it in the chat again. If you want to know if your Social Security, how much of your Social Security benefits will be taxed, you have to include half of the Social Security benefits in that calculation. Isn't that interesting? So you take your AGI, which could be dividends, income, capital gains, all of that, right? So that's part of AGI. Plus you add tax-exempt interest. Don't forget that, don't exclude it. Plus you add your foreign income. If you have a property in, I don't know, in Paris, that rental, and you get 10,000 a year income from that, you include that too. Plus 50% of your Social Security benefits. This becomes provisional income. If this provisional income is over $44,000 and you're married, up to 85% of your Social Security benefits will be taxed.
Okay, thank you. If anybody else has any questions, please enter them in the chat box, or you can unmute yourself and ask Larissa directly.
While we're waiting for some questions to come, and you're welcome to ask anything. There's no bad questions, no silly questions. Social Security is very challenging to understand. There is a lot of moving parts. Even myself, I'm constantly learning and relearning it because they change that. They change the formulas. They change. They recently, took away this file and suspend benefits. They're constantly moving. By the way, don't be surprised for those folks that are younger. It is very likely they will push full retirement age till age of 68 to 69, which is good for those who are collecting now, will be collecting soon, because they want to make sure there is enough money for those who need to collect. So people living longer, that's a challenge for Social Security fund. And also, as people live longer, they work longer. So full retirement age has been pushed out further and further out. So 70 would be probably in a few years as a norm. It doesn't mean that for those folks who were born in 1960, the age for full retirement will be pushed out. No, that's already set. But for people maybe born 1980s, their full retirement age easily can be 68 to 70.
Okay.
Things are changing all the time. Yeah. Right. So we need to be prepared for it. Also remember, Social Security will never replace 100% of your income needs. Best case scenario, best case in this area is 1/3. If you're outside of California, you're in a different state, that could be 40% of your income needs. Rarely is 50%. If you're living overseas, if you're one of those clients that I have who work here long enough, they just retired in France they went to Italy, they actually can live on Social Security benefits alone and supplement a little bit from other sources. I have clients who live in countries like Argentina, Brazil, Thailand, and they can live pretty much on Social Security benefits plus small influx from other sources. So there is a way to slice and dice it, but Social Security usually is only portion of what you would need in retirement.
There's another question. So Delia is asking, would she get a refund back for tax Social Security after full retirement age?
Do you get a refund back for taxes, Social Security after full retirement age? A refund?
You could, right? You might be able to, depending on if you have other income.
Right. So basically, what you're saying is, let's say you overpaid through your withholdings from Social Security, right? If that's the case, yes, of course, there'll be recalculation. They take into consideration all of your income. They'll see where you fall, and then the calculation will be made automatically by tax software to determine if you're underpaid or overpaid. And if you overpaid any taxation, of course, you get refund. There is no questions asked. There is never, a time where if you IRS owes you money, they pay you right away upon you file your tax return. Yes.
Somebody asks, are distributions from 401ks, etc., counted as income for the purposes of calculating combined income and percentage of Social Security subject to tax?
Absolutely, yes. Absolutely, yes. Because your 401k distributions is considered an ordinary income, and it falls above the line when you calculate AGI, adjusted gross income. So IRA distributions, dividends, interest, tax-free income, your business income, everything above that line of AGI will be subject to that calculations and will be considered during your Social Security. How much of it is taxable? Absolutely, yes.
I have a question about working after you've already claimed benefits. Do your Social Security benefits change at all if you work after you've claimed?
Great question. I love this question. Yes. So if you continue working, let's say you continue working and you're not collecting benefits, your Social Security is increasing. It's going up and up and up and up. And I believe if you continue working beyond 70, I'm not sure if up to 70 your Social Security benefits are increasing. They might not. But as long as you work till that age, your benefits are going up because you're making contribution into the system. So those contributions are increasing your benefits. But remember, it's the highest 35 years of earnings, right? So highest. So if you making the same income, they might not take those income into consideration formula anymore, right? So it's only 35 highest. So if you work 40 years, but out of 40, 5 were the same, then they only take your highest 35. So you're increasing the chance and the contributions, the benefits will grow as you contribute to the system. But they might grow faster or slower depending, again, on your earnings history.
Okay.
And even if you don't work, they still can go up because of inflation if you wait. And that number is 8% increase. If you retired at 60, let's say you are born in 1960, right? You retired at 67, full retirement age, but you say, I'm not going to collect. I'm fine. I have other sources. My husband is still working. Then you wait, and every year you wait, your benefits go up 8% guaranteed, which is phenomenal. 8% guaranteed return you cannot get on the market, but here you can get. So very smart to wait if you can.
Okay. Mina asks how to hold or tax exempt from Social Security. Let's see, is there any form to hold?
I can try to read it if it's there. Yeah, I'm not seeing the question.
Do you see?
The last one about 401k, I see. Is it
okay. Yeah, she
directly to you. Maybe they send it directly.
Okay. Yeah. I guess she's asking if there's any form or procedure to withhold federal and state tax.
Yes, there is. So there's two options. You can notify Social Security Administration that how much you want to take out, federal and state tax, and they will withhold it for you automatically. and then that will be part of your payments to IRS, or you can make estimated tax payments based on those benefits. My advice, do not make estimated tax payments. You can forget, they might not be accurate. Just ask Social Security Benefit Office to withhold federal and state tax percentage based on your effective tax rate on your most recent tax return. For instance, you receive your tax return, it says your effective rate in your tax summary is 10%. You tell them, administration, that I would like to withhold 10% out of my Social Security starting January 1st. And then readjust every year if the tax rate changes.
Okay. All right, thank you. I don't see any other questions.
Any questions? Okay, great.
Yeah. Okay. So as I mentioned, I will make the recording available to everybody once we've had a chance to edit it. Okay. Thank you so much, Larissa. Informative.
Thank you, everybody, for joining. It was great, and thank you for participation as always. Thank you.
Thank you.
Appreciate
Good night.
everybody. Good night.